62% in taxes. This is what the UK government can charge you at the very highest rate. Now, I'm going to tell you today exactly how they charge you 62% and the ways that you can potentially reduce it using creative strategies, making sure you make the most out of the money that you earn, pay the least amount of tax. So how do the government actually charge you 62% tax? That's 62% of your earnings going to HMRC. £100 in, £62 out, £38 left for yourself. Ludicrous. Now, it's what's called abatement of personal allowance. Once you get to £100,000 in earnings, there's essentially a bracket of income where you begin paying 62%. Every £2 you earn, you lose £1 of your personal tax-free allowance. Personal tax-free allowance being the first £12,570 of earnings that you pay 0% in tax, whether it's employment income, dividends, or any other source of income at all. They essentially start stripping that away from you, meaning that initial part of 20% tax relief you got, you no longer get. And you're also in higher rate tax at this point, meaning you're paying 40% income tax rate. You're also paying 2% national insurance. Adding these together, 20%, 40%, and 2%, that gets to the, sadly, 62% number that HMRC start charging you throughout this bracket. Even for you UK business owners that are taking dividends, this is still going to affect you, albeit it's 53.75% instead. If you've watched my other videos, you'll see that I construct the best director's salary to pay yourself, how to distribute earnings at the lowest tax rates possible, meaning usually 12,570 in employment income, the remainder is dividends, meaning that you still are subject to the 20% pullback when you start abating your personal allowance, and then you have to pay your 33.75%, which is your dividend tax rate at that point in time. So still 53.75%, even if you're taking dividends and not necessarily an employee, subject to income tax rates. Now that's the bad news. I'm gonna tell you the good news. There is ways that you can minimize and mitigate your tax liability from being 62%. Step number one, so typical accountant's playbook, pension contributions. If you're earning between the 100k and the 125, 140, where this abatement of personal allowance actually starts, which is the whole reason for the 62% in the first place, you lose your personal tax-free allowance, 20%, you're already at higher rate, 40%, and you're paying NI 2%, 62% in total. That's how we get to that number. If you then put money into a pension and you contribute, you're reducing your adjusted net income, which essentially means you get 62% tax relief on whatever you put in a pension while you're inside that bracket. So here's one way to start to mitigate that amount that you pay while putting money away for the future. But it does put money away from the future. It's locking away. You can't then go and access it tomorrow or next week. So you do have to give up that level of earnings to reduce your level of tax. It's worth noting there's limits, there's criteria on pension contributions, so make sure you tax plan accordingly with your accountant. Option number two, salary sacrifice schemes. Essentially, a government-backed program that allows you and your employer to have an agreement that you receive less in earnings, sacrificing that for non-cash benefits, which reduces national insurance, reduces income tax, and if you're in the bracket of 100 to 125, 140, you're going to save 62% on whatever you sacrifice. Now, non-cash benefits could include company cars, could include pension contributions, it could include childcare vouchers. There's numerous different things that you and your employer could agree for you to sacrifice your earnings in receipt of the non-cash benefit. However, you are again sacrificing your earnings, reducing the amount that you actually take in order to get the tax saving. Third option is maximizing tax deductions. So if you're an employee and you are earning 125k, but you use your personally owned vehicle for company miles, wear and tear, you can attribute the value 45 pence per mile for the first 10,000, 25 pence for anything after. You can attribute that total value to your tax return and reduce your adjusted net income. If you're claiming from working from home, or you purchase some equipment that could be deemed wholly and exclusively for the purpose of your job, you can reduce your net income and therefore reduce the amount of tax that you pay within this death tax bracket. Option number four, you can make charitable donations, reducing your adjusted net income, again, reducing the overall tax that you pay. This is an option for people that want to give back, be impactful, and reduce their earnings so they're not paying it all to HMRC. Instead, they're paying it to a good cause. 5, 6, and 7 start to get a little bit more exciting, so make sure you watch on. Number 5 is VCTs, EIS, SEIS, which is essentially you investing funds into a varying range of different businesses or portfolios to get a return over a prolonged period of time. And HMRC have backed these different schemes or investments by giving tax relief for them. Tax relief varying 30% right up to 50% and onwards. Now, when you're doing this, you're putting your capital at risk. And you're also not having a sure investment like a pension contribution. For SEIS, you're putting into early stage startups, businesses that have potentially just got off the ground. They're looking at launching a software, or they've got a new innovative solution for a certain industry. So there's potential high returns, and for that, HMRC give tax relief. EIS is for larger businesses, businesses with trading history of up to 7 years, 250 employees. So these are larger businesses that are already off the ground. They've already got reliable revenue streams and consistent business. However, you're still investing capital. It's a way of fundraising for these companies that HMRC have backed, giving you the tax relief. VCTs, venture capital trusts, they aren't direct into one business. They're usually portfolios where you essentially invest into a portfolio and they then spread the funds between different types of companies, again, giving you tax relief. So this is an option that you need to do your due diligence on. Definitely need to do some new reading and make sure you look at it, but it is an option. Number 6 is utilizing a corporate group structure, which brief outline is a holding company that you have shares in, either 100% or partial, owning subsidiary businesses that can be your trading companies, your SPVs, or investment businesses. These form a group structure. There's numerous tax relief available and different benefits, and that's a whole nother video in itself. However, when you have a group structure, you can use funds from one of your trading businesses to, rather than take out personally and have to spend on lifestyle, pushing you into them higher tax brackets, you can still invest and get a strong return on capital by doing it within the group structure. So let's run an example. I'm currently earning 125k personally. And as of now, personally, I'm filling up my ISA allowance. I'm putting some money away for rainy day funds. Instead, you can pull back the amount you take in personally, push funds from your trading company up to your holdco, either invest direct in your holdco or push money down to an SPV investment business and start to invest in corporate unit trusts, putting money in the S&P 500, putting money into cryptocurrency assets, or whatever you want to do based on your risk profile and time horizon that you'll be investing for. This can give you a sense of return on investment, a sense of building your net worth that you own without having to pull money out personally and push that personal tax liability up further and further and further. And option number 7, the final option for this video, is having your residency elsewhere than the UK. That's overseas, the UAE, Portugal, Monaco, wherever the places that you reside. The income tax rates or the tax rates for dividends at that rate will be a lot less than the UK. Meaning that if you are drawing funds from UK business or you've got overseas income, then your effective rate of tax will be much less because you're not going to be subject to UK taxes. So this is a way to avoid it entirely, but does require you to move overseas and spend less time in the UK. Potentially anything over 90 days is going to pull you in as a UK tax resident for the majority of cases, but this is dependent on your statutory residency tests and any automatic ties, as well as numerous other things. So make sure you do the proper tax planning, and if you are considering an overseas move, this is obviously a way to drastically reduce the personal tax you pay. So there you have it. There's 7 ways that you can mitigate the 62% tax trap in the UK. Hopefully that was useful for you. Some more complex than others, some simpler, some that won't apply to you and some that will. But hopefully you take value and save some tax.